Welcome to The Deep Dive, the show where we cut through the noise of earnings calls to bring you the essential insights you need. Today, we're doing a deep dive into New Mountain Finance Corporation's Q2 2025 earnings call. That was back on August 5th.
Yeah, and this call, it really presented kind of a mixed bag of results, I'd say. Management was clearly emphasizing credit discipline, shareholder value too, but, it's all happening amidst a pretty challenging rate environment, and there were some notable portfolio shifts.
Definitely. We'll unpack what matters most for you. So let's kick things off with the headline numbers. Adjusted net investment income, NII, which for a BDC like New Mountain is basically their EPS equivalent. It came in at $0.32 per share.
Right, and that was pretty much bang in line with market consensus, so no big shock there.
No surprise on that front. But total investment income, their top-line revenue?
Yeah, that one slightly missed expectations. They reported $83.49 million. Consensus was $84.57 million.
Okay, so about a 1.3% miss. Small, but...
But noticeable, yeah.
Yeah.
In this sector, you watch those numbers closely.
Exactly. And then net asset value per share, the NAV.
That saw a bit of a decline, down $0.24 quarter over quarter, landing at $12.21 per share.
So that's about a 1.9% decrease. Again, not huge, but it's moving the wrong way.
It is. But on the flip side, and this is important for income investors, the board declared the Q3 dividend at $0.32 per share.
And crucially,
fully covered by that NII figure. So the dividend itself looks solid, covered by earnings.
Right. That's a key positive takeaway. So how did the market react immediately after the call?
Well, it seemed to reflect that mixed picture. The shares slipped about 1.9% on the day of the call, closed around $10.33.
Suggesting caution then.
Yeah, I think so. It suggests a sort of cautious sentiment, this slight revenue miss, the dip in NAV, even with the dividend being covered. It seems investors are maybe taking a bit of a show-me stance.
Okay, let's unpack this more. Let's get into the nitty-gritty of the call. Beyond those headlines, what really stood out on the financials, the strategy?
Well, what's fascinating, I think, is the portfolio composition. Management really highlighted this continued rotation towards senior-oriented assets.
Okay.
They're now at 78% of the portfolio. That's a pretty significant number. It reflects, a real commitment to credit discipline.
78% is high, even for a BDC focused on senior debt. That's quite defensive.
It is. And they back that up by saying roughly 95% of their investments are rated green on their internal risk scale.
Okay, that's good context. What about leverage?
Their statutory debt to equity was 1.17x, or 1.13x if you net out cash. So comfortably within their target range, no red flags there.
And they seem pretty confident in their own stock valuation, right? Given the buyback activity.
Precisely, yeah. They're putting their money where their mouth is. They repurchased $9.6 million of shares just in Q2.
And more authorized.
Yep, another $31 million authorized. So it clearly signals management thinks the stock is trading at an attractive discount to that NAV we mentioned.
That's a strong signal.
It is. And another key strategic move, they secured their third SBIC license back in July.
Right, the Small Business Investment Company license. How does that help?
It basically gives them access to lower cost, long-term leverage for certain qualifying assets. It helps diversify their funding mix and potentially boost returns on those specific investments. It's a smart move structurally.
So leadership's message sounds consistent. Stephen Klinsky, the chairman, talked about maintaining credit discipline, delivering the dividend.
Exactly. And John Klein, the CEO, really emphasized that push into a more senior loan mix, more diversification.
But that push into senior loans, while it sounds safer from a credit perspective, brings up interest rate sensitivity, doesn't it? Especially with floating rates.
Absolutely. That's the trade-off. With 86% of their loan portfolio being floating rate.
86%. Wow.
Yeah. And about 49% of their liabilities are also floating rate. They are trying to evolve the capital structure to align those better. But management did acknowledge pretty directly about an 8.2% II sensitivity, meaning their net investment income could drop by roughly 8.2% for every 100 basis point cut in base rates. So one full percentage point cut by the Fed could take a decent bite out of NII.
Okay, that's a key risk factor for investors to track then, especially if the thinking is rates might come down eventually.
Exactly. How effectively can they manage that exposure if or when the Fed starts easing? That's the big question.
We also heard about some shifts within the portfolio itself. Even with 95% rated green, there were some movements.
Indeed. That 95% is the overall picture, but there's always movement underneath. A small segment, less than 3% of the portfolio by fair value, saw some downgrades.
Okay, what was the main one?
Most notably, a consumer products company. This one had been flagged before as sensitive to tariffs. It migrated from their internal yellow rating to red.
Red meaning impairment.
Yeah, red implies a direct impairment to the value of NMFC's investment. It likely means a pause in interest payments, too, which hits NII. This company has a very China-centric supply chain facing significant performance issues.
And needs cash.
And will require liquidity support before year-end, according to management. They still express some optimism for a long-term recovery, but the immediate concern is definitely real there.
Got it. Any others?
There were some modest declines noted in positions like Momentum, which is an edtech business, and a dental healthcare business, mostly due to things like capital structure dynamics or maybe labor inflation pressures hitting their performance.
So even in a defensive portfolio, specific risks can emerge. What about new deal flow? Were they active in Q2?
It was actually a lighter quarter for putting new money to work. About $122 million in new assets originated.
Okay.
But that was more than offset by $155 million in repayments and sales. So net, they actually saw capital come back.
Which allowed them to?
To rotate out of some positions. They mentioned exiting Office Ally, including some common equity they held there, and also RKS preferred shares.
And redeploying that capital.
Exactly. Using the proceeds to reinvest in those senior cash-yielding loans, reinforcing that defensive strategy. Management said their underwriting bar remains very high.
Focusing on specific sectors.
Yeah, defensive growth sectors. Think software, business services, healthcare. Areas where they feel they can get unlevered returns of maybe 9-10%, because they tend to be more resilient. They're being selective.
Okay, so pulling all this together, what does it mean for you, the investor, looking at NMFC now, especially with that slight share price dip after earnings?
Well, connecting the dots, that neutral to cautious market reaction, it seems pretty warranted, honestly.
Because?
Because while the dividend coverage looks solid and management is clearly managing the portfolio defensively towards senior assets, you still have the slight revenue miss, that dip in NAV, plus those potential NII headwinds if rates fall. It creates a kind of show-me sentiment. The market wants proof.
Right. How are they stacking up against the broader BDC sector? Are they keeping pace?
That's a really important comparison. If you look at a common BDC sector proxy, like the ETF BIZD, its one-year total return through August 2025 was roughly, let's say, 9 to 12%.
Okay.
Decent NMFC's 12-month total return over a similar period, negative single digits.
Ouch. So significantly underperforming the sector proxy.
Yes, and that really reflects the persistent discount to NAV that the stock has been trading at for a while now.
And the whole sector is tied to the Fed, right?
Absolutely. The industry backdrop is very much linked to the Fed's rate path. If spreads tighten or if the Fed does cut rates, that could trim asset yields for floating rate portfolios like NMFCs. They reported an average portfolio yield of 10.6% at cost, so any pressure there matters.
So looking ahead, what are the key things investors should really be watching? What's on the radar for the next few quarters?
Okay, key catalysts to monitor. First, the Q3 dividend cash payment. That's due September 30th. Confirmation of continued coverage is obviously vital.
Of course.
Second, any new clarity on the interest rate path from the Fed, given that 8.2% II sensitivity. That's huge. Third, deployment of capital under that new SBIC license. How quickly and effectively can they put that cheaper leverage to work?
Makes sense. What else?
Continued share repurchases. If the discount to NAV persists, will they keep buying back stock? That signals management conviction.
Right.
And then, of course, just monitoring credit migration. Any more shifts from green to yellow or red, and what happens with NAV in the next 10Q and the next earnings call.
Anything specific management mentioned about future plans?
Yes. Importantly, they outline plans to refinance some higher cost debt. The goal is to reduce their overall financing costs and better align the floating rate liabilities with their floating rate assets. If they pull that off effectively, that could be a significant positive for NII down the road.
Lots to watch then. Okay, it's time for our This Is Not Financial Advice segment. We pitch an outrageous but plausible trade idea based on what we've discussed. Given NMFC's situation, the covered dividend, the buybacks, but that stubborn discount, what are you thinking?
Okay, here's where it gets really interesting potentially. Considering that sustained dividend coverage, management's quite aggressive buyback strategy, and that persistent, significant discount to NAV, an outrageous but I think plausible trade could be a long-term hedged position targeting NAV convergence.
Okay, break that down. What does that look like?
So the idea is you're betting that the stock price currently well below NAV, will eventually move closer to its net asset value per share. The market might eventually recognize that value.
How would you structure it?
Specifically, you could consider buying NMFC shares. That lets you capture that pretty robust dividend yield, currently over 12%, plus any upside if the stock price does converge towards NAV. That could happen if management executes well on, say, optimizing their liabilities or deploying that SBIC capital effectively.
But there are risks.
No.
The rate sensitivity, the credit issues.
Exactly. So simultaneously, you'd implement a hedge, maybe something like a slightly out-of-the-money put spread, expiring perhaps 12 to 18 months out.
A put spread, buying one put, selling another further out of the money.
Right. It defines your risk on the downside. It provides some protection against further NAV erosion or, unexpected credit blowups like that consumer products company we talked about.
Yeah.
Those can happen.
So long stock for the yield and convergence upside, put spread for defined downside protection.
Precisely. It's a strategy that plays on the idea that management's own conviction, shown by the buybacks, plus the sustained dividend from a defensive portfolio, might eventually overcome the market skepticism and narrow that discount, even if it's a slow grind.
A patient value play, basically.
Yeah, you got it. Betting on intrinsic value catching up, but with a safety net against those known risks like rate sensitivity and specific credit issues. It's definitely not for the faint of heart, requires patience, but I think the underlying logic is there for a calculated longer-term perspective.
It was a fascinating deep dive into New Mountain Finance's latest call. A company clearly committed to its dividend, pushing a defensive senior-oriented portfolio.
Yep.
But also navigating that slight revenue miss, the dip in NAV, and all against this backdrop of shifting interest rate expectations.
The mixed signals are definitely clear. You've got strong credit discipline, solid dividend coverage on one side, but then NAV pressure and those interest rate headwinds on the other. It really just highlights the tricky balancing act BDCs are facing in this environment. It's a continuous tightrope walk.
Absolutely. And as always, please remember, everything we've discussed here today is purely for informational purposes. It should definitely not be considered financial advice.
Please do your own due diligence. Maybe consult with a professional advisor before making any investment decisions based on this.
Definitely.
And maybe for you, our listener, here's just a thought to chew on as we wrap up. If a company's management believes its stock is undervalued enough to consistently buy back shares, and the dividend remains well covered by earnings from a defensive portfolio, what does a persistent market discount to NAV truly signify about the long-term perception of value? Maybe not just for this company, but in the BDC sector more broadly.
Is it a warning sign the market sees something management doesn't? Or is it just an opportunity the market is simply too slow or too skeptical to recognize right now?
Something to think about.
Indeed. Thank you for tuning into The Deep Dive. We look forward to bringing you more essential insights from the world of earnings calls very soon.